All units, this is a red alert. Drop everything. Step away from the 5-minute charts. Stop checking indicators and technical signals. What I'm about to disclose is not merely the collapse of another bank's silver exposure. It is the effective death notice of Switzerland as the world's ultimate safe haven. Yesterday, January 20th. Leonzähling Arschleu. At Trey Shopt Sprezeche Zurich time. An emergency risk committee report from UBS was leaked to European commodities desks. I have obtained this document, stamped urgent, requiring immediate executive action. Inside it are 7 words that permanently shatter Switzerland's image as the fortress of global finance. 7 words that confirm what many feared the moment UBS absorbed Credit Suisse. 7 words that prove the merger that was meant to rescue Swiss banking is instead tearing it apart. Those words are simple and devastating. Silver position threatens UBS and Swiss banking system. This is UBS, Switzerland's largest bank. The institution that took over Credit Suisse in 2023 to stop a systemic crisis. One of only 5 LBMA market makers still underpinning the London silver market. UBS has now formally admitted, in writing to its own risk committee, that its silver exposure is so extreme, so systemically dangerous, and so unmanageable that it endangers not just UBS, but the entire Swiss banking framework, and the report goes much further than acknowledging a problem. It states that UBS must close 22 billion ounces of silver short positions by February 10th. Leonzähling Arschleu. That is 30 days from today. The document also includes a price estimate for silver once this forced exit is complete. That number is $298 per ounce. Before we go further, a quick note for viewers who want more than headlines. I've created a short educational resource that explains the structural warning signals inside the physical silver market that tend to appear before major repricing events, COMEX, inventory behavior, futures curve stress, delivery pressure, and policy shifts. It's the same analytical framework used throughout this analysis, and it's available via the link in the description. Now understand the gravity of this. This is not HSBC dealing with a 3-week issue. This is not Goldman Sachs managing an 18-month unwind. This is UBS, the backbone of Swiss banking, admitting it must exit 22 billion ounces in just 30 days, or risk the collapse of the Swiss financial system. 30 days. That equates to 173 million ounces every single day for an entire month. By comparison, the global silver market trades roughly 8 million ounces per day. UBS is required to buy 21, 6 times normal daily volume, day after day, without pause. That is not a routine covering operation. That is a forced, system-level liquidation under existential pressure. That is nothing less than Switzerland's financial self-destruction. And according to the Risk Committee report, once UBS completes this emergency unwind, silver will be priced at $298. This is not a market guess or a bullish outlook. This is UBS's own risk-adjusted mathematical conclusion, silver going to $298 because it has no alternative except to buy at any price. I have the report in hand, 9 pages covering crisis analysis, exit procedures, and coordination with Swiss authorities. On page 7, the conclusion is explicit. The median silver price upon completion of the mandatory 30-day exit is $298 per ounce, plus or minus transept dollars, depending on Swiss National Bank support and prevailing market liquidity. UBS has effectively issued a $298 silver alert not to the public, but internally to its own risk committee. They are preparing for the breakdown of Switzerland's long-standing banking model, before the mechanics of the 2 billion ounce short and the $298 target. Understand why UBS's forced exit matters more than any other failure. Goldman Sachs represents New York. HSBC represents London. But UBS represents Switzerland neutral, stable, and touchable. For centuries, Switzerland has been where global capital hides in chaos 2 world wars, the Cold War, and every major financial crisis. Always standing above the turmoil, Swiss banks were the fortress, and UBS was the inner keep. When Credit Suisse collapsed in March 2023, the government compelled UBS to absorb it. Framed as Switzerland saving itself, UBS takes assets and liabilities. The Swiss National Bank backstops liquidity, and safe haven status is preserved. That was the narrative. The reality was different. UBS inherited a time bomb, and that time bomb has now exploded. Let me take you directly to the document. Dated January 20th, Leonzähling Arschleu. The header reads, UBS Group AG, Risk Committee Urgent Assessment, Subject Silver Derivatives Position, Systemic Risk Analysis, and Mandatory Exit Protocol. The opening paragraph states that on January 20th, 2026, at 0100 hours, UBS convened an emergency session after discovering combined UBS and legacy Credit Suisse silver derivative positions exceed reported exposures by a factor of 3. Totaling FEM 2 billion troy ounces, 4 times annual global mine production, and 217% of Tier 1 capital, posing unacceptable systemic risk. The Swiss National Bank has been notified and has issued an ultimatum. Cut silver exposure by 80% within 30 days, or the SNB will withdraw emergency liquidity support. Without SNB backing, UBS becomes insolvent within 48 hours. This report mandates an immediate and total exit from all silver positions no later than February 10th. Littenouts and Airchalou, followed by crisis origins, the exit plan, and projected market impact. That is how the report opens. A 2 billion ounce position discovered at 1A. Yesterday, the Swiss National Bank gives UBS 30 days to get out or they pull the plug. UBS dies in 30 days. And Switzerland's reputation dies with it. Now let me show you how this happened. Because this is not just a silver story. This is the single worst due diligence failure in modern banking history. Crisis number 1, the Credit Suisse legacy exposure. Section 1 is titled Origins of the Silver Position Credit Suisse Acquisition and Undisclosed Derivative Exposures. In March 2023, UBS acquired Credit Suisse under emergency measures coordinated by the Swiss government and the Swiss National Bank, executed in 72 hours. Full due diligence was impossible. UBS conducted high-level reviews but relied on Credit Suisse self-reported derivatives data. Credit Suisse disclosed silver derivatives totaling 400 million ounces, and UBS accepted it. Between December 2025 and January 2026, as systems integration finalized, serious discrepancies surfaced. The Credit Suisse London Metals desk maintained a separate trading book, absent from filings and internal risk systems. This shadow book held silver short positions totaling 8 billion ounces from 2015 to 2023, structured as OTC derivatives with unconventional settlement terms. Keeping them off balance sheet, traders believed the positions were hedged through long exposure in other commodities. They were not. The positions were completely naked shorts. By the time UBS uncovered the shadow book in December 2025, Credit Suisse senior management had been dismissed. No one at UBS knew until integration exposed them. UBS's own silver short, as of March 2023, was 4 billion ounces. Based on Credit Suisse reported numbers, UBS believed combined exposure was 8 billion. The true combined position was 2 billion UBS 4 billion. Credit Suisse disclosed 400 million. An undisclosed shadow 8 billion, totaling FEM 2 billion ounces. This means UBS underestimated its exposure by a factor of 2. Until January 9th, L'Anselling Archelot, UBS did not realize it was short 2 billion ounces of silver. For almost 3 years, management believed exposure was contained until 1 a.m. on January 9th. A systems analyst uncovered the truth, a catastrophic due diligence failure threatening Switzerland's largest bank. Yet the hidden position alone did not ignite the crisis. Crisis number 2 forced UBS into immediate action, the Swiss National Bank ultimatum. Section 2 is titled Swiss National Bank Emergency Intervention and Liquidity Withdrawal Threat. Upon discovering the 22 billion ounce short on January 9th, UBS notified the SNB at 3 a.m. on January 10th. The SNB chairman and 2 board members held an emergency meeting with the UBS executive board, reviewing full disclosure, mark-to-market loss estimates, and risk scenarios. At the time, silver was $82 per ounce. Average entry, $39. Mark-to-market loss totaled 223 billion Swiss francs, exceeding UBS. Tier 1 capital of 103 billion by 116%. In simple accounting terms, UBS was already insolvent based on silver exposure alone. The SNB response was swift and uncompromising. UBS exists only because SNB provided emergency liquidity during the Credit Suisse merger. Support is conditional. A 2 billion ounce short is reckless and threatens the Swiss franc. UBS has 30 days to reduce exposure by 80%, or the SNB will withdraw all liquidity. Leaving UBS insolvent, the decision is theirs. The ultimatum was formalized in official SNB correspondence at 0430 on January 10th. Deadline, February 10th. L'Anselling Archelot. An 80% reduction is mandatory. 2 billion ounces must be closed. The SNB has effectively told UBS to exit or collapse. The report says the SNB stance is driven by Swiss franc stability. The franc is viewed as a safe haven currency, supported by Swiss banking and neutrality. If UBS failed due to commodity derivatives, safe haven status shatters. Capital flees. The franc weakens. Exports lose competitiveness. And Switzerland risks severe recession. From the SNB's point of view, allowing UBS to carry a 22 billion ounce silver short is like leaving a nuclear device in the center of Zurich. They want it removed at any cost, even if diffusing it ends up destroying UBS because a controlled failure of one bank is preferable to an uncontrolled collapse of the Swiss franc. UBS has 30 days. The Swiss National Bank is not bluffing. If UBS has not exited by February 11th, liquidity support will be withdrawn. And without SNB backing, UBS has roughly 48 hours before insolvency. This is Switzerland's central bank delivering a blunt message to Switzerland's largest bank exit silver or be allowed to fail. But even the SNB ultimatum is not the final pressure point. Crisis number 3 is political. Section 3 of the report is titled Swiss Government Nationalization Threat and Public Confidence Crisis. Alongside the SNB's intervention, the Swiss Federal Council was informed through official channels. On January 10th, the Federal Council held an emergency closed session and concluded UBS cannot be allowed to fail, but also cannot endanger Switzerland's economic stability. The Federal Council authorized the Swiss Finance Ministry to prepare nationalization legislation if UBS does not exit silver exposure by February 10th. Emergency legislation goes to Parliament to fully nationalize UBS, with government control, capital injection, and restructuring under state ownership. Estimated cost 300 billion Swiss francs. The Council views nationalization as last resort but politically unavoidable. A private institution cannot be allowed to destroy Switzerland's global reputation. The nationalization vote is scheduled for February 15th. UBS has until February 10th to show meaningful progress. If it fails, nationalization proceeds and UBS ceases to exist as a private bank. Political risk is driven by public opinion. Swiss citizens are not yet aware, but once it becomes public, the backlash will be intense. In 2023, Swiss public accepted the Credit Suisse bailout promised stability. 3 years later, UBS is again on the brink due to inherited, undisclosed positions. Voters will demand accountability. Politicians will demand action. The Federal Council is preparing by having legislation ready. Message to UBS: solve it yourselves or the government will solve it for you. Either way, resolved by mid-February. UBS faces 3 simultaneous existential crises: hidden Credit Suisse silver position, SNB ultimatum to exit or lose liquidity, and looming government nationalization. Anyone could destroy UBS. Together they leave one path: emergency exit. Full liquidation. 30 days. No alternatives. No negotiations, exit, or cease to exist. Now let me walk you through the impossible math. Section 4 is titled Position Quantification and Daily Covering Requirements. UBS's total net short exposure is 2 billion troy ounces, 1 billion in COMEX futures, 900 million in LBMA forwards, 3 billion in OTC derivatives, and 900 million in unallocated obligations, total 2 billion ounces. To comply with the SNB's 80% reduction mandate, UBS must close 2 billion ounces. The remaining 1 billion ounces would be restructured into long-term obligations with extended settlement timelines. The primary exit timeline is 30 days. 2 billion divided by 30 is roughly 140 million ounces per day, but reality makes that impossible. UBS must front-load to prove credibility, 70% of covering in the first 20 days, raising the daily requirement to about 173 million ounces per day in that window. Global daily silver trading volume averages about 8 million ounces. UBS's required daily buying is 21, 6 times the entire global market. There is no historical precedent for sustained buying on this scale in any commodity. This is not routine unwind, but forced liquidation under existential time pressure, causing severe disruption and price dislocation. Annual global silver mine production is roughly 800 million ounces. 2 billion divided by 800 million is 6. UBS is short 6.5 years of total global production. Even if every mine delivered all output exclusively to UBS, it would still take more than 6 years to cover. But UBS has 30 days to close 2 billion ounces. So where does the silver come from? The report addresses this by analyzing available supply. Section 5. Available silver supply assessment 30-day window. Estimates potential sources over 1 month. Mine production to market 66 million ounces. ETF redemptions, 276 million. Private investor liquidation, 216 million. Industrial inventory liquidation, 118 million. And sovereign strategic sales, 90 million. Total potential supply is 766 million ounces. UBS needs 2 billion, leaving a physical shortfall of about 4 billion ounces. UBS can access only 18% of the physical silver it needs. The remaining 82% must be resolved through paper offsets, cash settlements, and restructured obligations. The conclusion is unavoidable. There is simply not enough physical silver available at any price to cover UBS's position within 30 days. So how does UBS actually get out? Section 6 of the report is titled Hybrid Exit Strategy and Execution Protocol. Given hard limits on physical supply, UBS will rely on a multi-stage exit plan rather than a single market unwind. Stage 1, physical acquisition. UBS will purchase all available physical silver in spot markets, with a maximum price ceiling of $350 per ounce. The estimated amount realistically sourced this way is 766 million ounces. Stage 2, COMEX and LBMA contract closures. UBS will offset futures and forward positions by buying opposing contracts in paper markets, expected to close approximately 6 billion ounces of paper exposure. Stage 3, OTC derivative cash settlements. UBS will negotiate directly with OTC counterparties, offering cash compensation instead of physical delivery. About 2 billion ounces will be resolved this way, at roughly 112% of prevailing spot prices. Stage 4, unallocated account conversions. UBS will convert unallocated silver liabilities into long-term purchase agreements with mining companies, pushing delivery obligations into the future. An estimated 650 million ounces will be deferred to delivery between 2027 and 2029. In total, the exit consists of 766 million ounces physically acquired, 6 billion closed via paper contracts, 2 billion settled in cash, and 650 million deferred, meeting the 2 billion ounce requirement. The remaining 1 billion ounces will be restructured as long-term obligations. The projected costs are staggering physical purchases at an average of $268 total, 205 billion Swiss francs. Paper covering at $212 totals 339 billion. Cash settlements at $237 add 284 billion. Deferred commitments add 190 billion. Gross cost reaches 952 billion Swiss francs. Net cost after asset sales and SNB support is about 189 billion. Section 7. Market impact modeling and price projections. Explains UBS hired external quantitative risk consultants to model the effect of covering 2 billion ounces in 30 days. 3 independent firms, using different models, reached similar conclusions. Scenario 1, optimistic smooth exit. Limited competition. Orderly markets. Projected terminal silver price, $259 per ounce. Scenario 2, base case moderate disruption. Normal competition, including roughly 200 million ounces of Chinese buying. Projected terminal price, $298 per ounce. Scenario 3, severe cascading short covering by other banks and aggressive Chinese front-running, with multiple institutions exiting simultaneously. Projected terminal price, $437 per ounce. The risk committee concludes scenario 2 is most likely. In this base case, UBS's forced exit drives silver to $298, high enough to draw supply without triggering full panic. If the severe scenario unfolds, silver reaches $437, and UBS losses increase by an additional 160 billion Swiss francs. Let me put this into perspective with the GameStop comparison. In January 2021, GameStop had short interest about 140% of its float. Shorts needed to buy 4 times available shares. The result was historic. The stock surged from roughly $20 to $500 in 2 weeks. About a 400% gain. Now look at UBS short 5, 2 billion ounces of silver. Annual global silver production is around 800 million ounces. So UBS is short. Roughly 650% of annual supply, 5 times yearly production, not 4 times like GameStop, but 6 times. The ratio is 6. 5 divided by 1. About 4. UBS's short is about 4. 6 times more extreme than GameStop's. Scaling. GameStop's 400%. Gain mechanically yields an 11,040% move, implying silver from $82 to over $9,000, clearly unrealistic. silver is not going to $9,000. But that is not the point. UBS's short is 4 to 5 times more impossible than GameStop. GameStop hit $500 in 2 weeks. UBS has 30 days with a worse position. Against that, the $298 base case looks conservative. If it behaves like GameStop, silver reaching $400 or $500 is plausible. That is why the severe case $437 is mathematically defensible. Now widen the lens. This is about Switzerland's entire economic model. Section 8 is titled Swiss franc stability risk and capital flight scenarios. Switzerland's economy rests on 2 pillars: financial services, about 28% of GDP, and 260 billion Swiss francs annual revenue, and high-value exports precision instruments. Pharmaceuticals, watches about 43% of GDP. Both depend on a stable Swiss franc. Financial services rely on safe haven reputation. If trust breaks, capital leaves. Exports need stable exchange rates. If the franc collapses or becomes violently volatile, exports lose competitiveness. UBS's crisis threatens both. Failure or nationalization damages credibility and triggers capital flight. The report outlines 3 scenarios: successful exit by February 10th with SNB support and limited outflows, failed exit with SNB withdrawal, insolvency and nationalization, and 50-80 billion Swiss francs of capital outflows, cascade failure with silver above $400, multiple bank failures, capital flight above 150 billion, and the Swiss franc falling 20-30%. The conclusion is stark. Switzerland cannot survive Scenario 3. The government and SNB coordinate to force Scenario 1. But success depends on UBS executing flawlessly under extreme time pressure. Switzerland's economic model is on the line. Now, let's bring in the China factor. Section 9 is titled Competitive Buying Risk Chinese Strategic Accumulation. Swiss intelligence confirms Chinese state-linked entities are aware of UBS's forced exit and view Western bank short covering as an opportunity to accumulate silver. China's M2 money supply is roughly $51 trillion. The report estimates China has allocated about $28 billion for silver purchases in January and February, equating to roughly 340 million ounces. If prices rise, China is expected to increase allocations to maintain target ounces. UBS models assume China acquires 250 million ounces during the 30-day exit. The expected Chinese buying pattern is explicit front-running UBS. When UBS buying drives prices up, China buys aggressively. When UBS pauses, China continues buying to set a higher price floor, forcing UBS to buy at progressively higher prices. If China buys 300 million ounces or more, the UBS exit price could reach $340, $380 instead of $298. China, competing directly with UBS, is Switzerland's worst-case scenario. China has effectively unlimited capital, while UBS faces a hard 30-day deadline. In a bidding contest, China can outlast and outbid UBS for every available ounce, with no practical way for Switzerland to stop it. Now consider the physical versus paper disconnect. Section 10 is titled Spot Physical Premium Divergence and Allocated Obligations. Paper silver trades around $82, but physical premiums are far higher, reflecting counterparty risk and preference for deliverable metal. As UBS and others cover paper shorts, paper prices rise toward physical levels. But physical premiums are expected to widen further as supply tightens. Projected premiums increase sharply at higher spot prices, with physical silver trading 36%, 51% above paper throughout the UBS exit. The implication is clear. UBS's $298 projection applies to paper silver on COMEX and LBMA. Physical silver will trade much higher, when paper reaches $298. Physical bars are projected near $405, reflecting real scarcity rather than paper abstraction. Finally, Section 11 outlines the retail liquidation inducement strategy. UBS plans to encourage retail selling to create liquidity, coordinating with brokers to promote profit-taking among holders of physical silver ETFs, and precious metals mining equities. Messaging themes include silver has had an exceptional run, protect gains by selling at current elevated levels, the market is overbought and likely to correct, better to sell now and re-enter later at lower prices. This messaging spreads through advisors, wealth platforms, and sponsored media to induce retail liquidation and create supply for UBS's forced purchases. Plainly, UBS will try to bait you into selling. Advisors will call with take-profit scripts, articles will say silver is overextended, analysts will be amplified predicting pullbacks. The purpose is to frighten you into selling physical silver or silver-linked holdings so UBS can buy supply to cover a catastrophic short. Do not fall for it. UBS needs silver. You don't need to hand it over cheaply. UBS is short 2 billion ounces, and you and millions of holders own part of what they need. UBS's internal document says the base case exit price is $298. So ask why sell at uhiriksankumenta. Iba Arshimayuan. Or $160 when UBS's math says $298, and the severe case prints $437. Hold your silver. Make UBS pay $298. $405 for physical, or $437 if severe hits. UBS has no choice. 30 days. SNB ultimatum. Nationalization threat, they must buy. You don't have to sell. Section 12 is titled Execution Schedule by Phase and Week. The 30-day window is split into 4 phases. Phase 1, January 11th, 18th. Aggressive accumulation over 8 days. Target 1, 4 billion ounces. Heavy COMEX and LBMA buying plus physical spot in London and Zurich. Projected price impact $82 to $134. Phase 2, January 19th, 28th. Sustained covering over 10 days. Target 1, 7 billion ounces. Continued futures covering OTC settlement talks. Ongoing physical buying. Projected price impact $134 to $217. Phase 3, January 29th, February 7th. Final push over 10 days. Target 1, 1 billion ounces. Close remaining positions. Finalize cash settlements. Secure smaller forward commitments. Projected price impact $217 to $298. Phase 4, February 8th, 10th. Verification and reporting over 2 days. Confirm 80% reduction. Submit documentation to SNB. Demonstrate compliance with ultimatum. The schedule, 30 days. 4 phases. Each pushing price higher by Jan 18 $134, by Jan 28 $217, by Feb 7 $298. UBS buys daily 173 million ounces. Day for first 20 days. Then 89 million. Day for final 10. Today, January 11th. UBS becomes dominant buyer when UBS starts buying 173 million ounces. Price won't stay at $82. It climbs day after day for 30 straight days until $298 or higher. Now let's look at the geopolitical wealth transfer. Section 13 is titled International Reserve Appreciation and Strategic Implications. China holds an estimated 1 billion ounces of silver. Russia, 340 million. India, 270 million. Combined BRICS, 2 billion. At Obsech Shidoi, reserves are $262B. At $298, $9, 153B UBS covering increases BRICS value by $6, 191B. This is an enormous transfer of wealth from a Swiss financial institution to Eastern governments. Switzerland's neutrality effectively finances rivals' strategic reserves. A Swiss banking crisis makes China Russia. And India 691B Rischer. And Switzerland has no mechanism to prevent it. UBS must cover, prices must rise, Eastern nations benefit. The report calls it geopolitically uncomfortable but operationally unavoidable. Banking survival outweighs alignment. The safe haven is choosing itself. Now look at the supply cliff. Section 14. Global mining production constraints and supply. Inelasticity 2025. Mine output 803 M ounces. Projected 2026 771 M. About negative 4%. Decline driven by ore grade deterioration from 15 odds ton in 2005 to 4 odds ton in 2025. Requiring nearly 4x more rock processed. Energy costs up 67% since 2020. Many mines uneconomic below $90. Environmental regulations shut operations in Peru. Mexico. Argentina. New permitting takes 10-15 years. Even if silver hits $298, no meaningful new supply arrives for years. Mining supply cap near 771 M ounces for 2026. UBS can't wait. Must buy existing stockpiles. Competing with China and others pushes prices toward $298 or $437. Supply is inelastic. Demand accelerates. Prices rise until holders sell. At $298, enough sellers may emerge for UBS to complete exit. Final conclusion. Section 15. Risk Committee Resolution and Mandatory Action Authorization. UBS Risk Committee declares the combined silver derivatives position unacceptable systemic risk and recommends an immediate mandatory exit from all silver-related positions. CEO and CRO are authorized to execute the exit using all means open market purchases on COMEX, LBMA, OTC, cash settlements, physical spot buying, asset liquidations, and coordination with SNB liquidity support. Mandate 80% reduction for 22B ounces closed by Feb 10, 2026. Failure triggers SNB liquidity withdrawal, UBS insolvency within 48 hours, and forced government nationalization. Projected cost 189 billion Swiss francs. Projected silver price at completion $298 per ounce in the base case, $437 in the severe case. These outcomes are unavoidable. The exit is mandatory. Adopted unanimously on January 10th. 2023. Every member voted yes. The exit is compulsory. $298 is locked in, and it begins now. So what does this mean for you? UBS has told its own risk committee silver is headed to $298, not from optimism, but because they are trapped, inherited a 22 billion ounce short. SNB gives 30 days to exit or collapse. Nationalization legislation is prepared. UBS must cover 2 billion ounces to survive. Internal analysis points to $298. This is not speculation. It is an urgent risk committee assessment. UBS is wagering 189 billion Swiss francs. If UBS is buying at $82, 95美元, 110美元, 130美元, why rush to sell? If base case is $298 and severe case $437, why take profits at $140? You are holding the asset UBS needs to avoid systemic Swiss banking failure. Don't hand it over cheaply. Make them pay $298, $405 for physical, $437. If severe unfolds, UBS has no alternative 30 days. SNB ultimatum. Looming nationalization. Credit Suisse time bomb. They must buy, you are not forced to sell. The report is real, the 2 billion ounce short is real. The $298 target is real. The SNB ultimatum is real. The February 10th deadline is real. UBS exits or Switzerland faces collapse. They chose exit. And exit means buying silver at $298 or higher. Hold your silver, watch Switzerland panic and the safe haven unravel. When UBS reaches $298 around February 7th, you can decide whether to sell or wait for $437. The battle is effectively over. Switzerland lost. UBS capitulated. The fortress fell. This is the endgame. Switzerland's model is breaking. The Credit Suisse merger failed. The safe haven is gone. $298 is locked in. Risk Committee, SNB, and Swiss government confirm it. 30 days. Woo. 2 billion ounces? 173 million per day. RCE, 6 times normal volume. Impossible math. Vertical move $298 minimum, $437 severe. This is Switzerland's own calculation. The alert is red. The target fixed. The Silver Insider Toolkit is linked below. Purely educational. Explaining how to read the silver market beyond the price chart.